Hello, everyone, and welcome to Commodity Culture, where we break down the commodity space for both new and experienced investors. Before we dive in, standard disclaimer: nothing here is investing advice. Do your own due diligence. And today's guest is the founder and editor of Wealth Research Group, Mr. Lior Gantz. Welcome to the show.
Thank you for having me.
Thank you for being here. So, I want to get started like I do with all new guests on their origin story. So, how did you first discover investing, and what ultimately drew you to the precious metals space?
Investing, I first got a wind of it when my father's business went under when I was 13. And to do a lot of things that I wanted to do, I needed to make money on my own. So I started babysitting in my neighborhood. That led to upselling some of these parents to let me coach basketball to the kids. And, by the time I'm 16, I'm handing out flyers. I'm doing anything I can make money, painting decks. And I got money saved up in a bank account. And the back then it was people used to invest in mutual funds. This is early 2000s, so no ETFs or all that type of stuff that we have today. And the banker's like, get your parents here. We get both of them here. They sign a waiver, and you can then start investing as a minor. And so that's what I did, and that's how I got into investing for the first time. Actually, it was June of 2000, so right after the dot-com bubble crashed and everything became normal again. That's luckily when I got into the first time. Started reading a lot of Peter Lynch books and some Warren Buffett books, and that's how I got started investing. Age 16, 2008. Late 2008. I fly to the States to start buying real estate when America is on sale. And I go into Barnes & Noble and I pick up Gold and Silver by Mike Maloney. And that's how I first got introduced to precious metals.
That's great. Love Mike Maloney's work as well. So these days, all eyes seem to be on the Fed, and I wanted to get your thoughts on their strategy here because there are many people I've heard who think the Fed will be forced to pivot. It's going to happen. A lot of people are saying in 2023. I've been hearing around summer 2023. Others believe Powell might be the reincarnation of Volcker, the new Volcker, and continue tightening until they reach somewhere close to 2% inflation, regardless of the calamity or the pain that would cause. How do you view things?
Powell, in the Brookings Institute interview just about 2 weeks ago, he explained that there will be no Paul Volckering. So he basically broke down inflation to three types of inflation. The one that the Fed can handle, supply chain inflation, and that's in his mind, that's a check mark. Then you have rental and shelter, and he believes that it's a lagging indicator, but it's starting to get under control. And then the third one is that we are missing about 2.5 million jobs in America because of the retirement boom that happened during the pandemic and people not coming back. And he doesn't feel like that's something that the Fed can help. And therefore, I think that his view is that we've done everything we can. Now it's about government policy, helping with new housing permits, incentives for businesses, and regulation, fiscal policy basically, and not monetary policy. They do believe that the balance sheet is too large. They'll keep reducing the balance sheet, and I think that they will hold in the next few months. But I don't see any reason, either politically or monetary one, to start cutting rates. So if by pivot you mean cutting, no, I don't see that. If by pivot you mean just pivoting from 75 to 50 and 25, I think that we're gonna see that for sure. And to me, the idea is that what happened in general is that in 2020 with the pandemic, the zero interest rate culture got intensified to a million. It's almost like you play a video game and then you have these turbo or nitro where you can pick it up and then you're racing. That's what I think happened. And it raced too fast, created inflation, created too much hiring in some sectors and a lot of retirements and quitting in other sectors. And as you open it back up, it doesn't go back to the way it was, which is what Powell's romanticizing about. I don't think that's the world we are entering in. And I think that ultimately, we are not in a classical recession because it's not mismanaged funds that got us here. it's a slew of other problems. So what I think needs to happen is more of what's happening right now, which is just a reset of expectations, a reset of risk, a reset of the jobs market. I think we're a few more months until we get to equilibrium, and at that point, it's gonna feel like a very slow discovery of the new economy that we're in. So definitely, I don't see this as a 2008. This is going to be classic 10% plus unemployment and all that. I don't think we are in that environment at all.
So, taking that thesis and looking ahead, how do you see the impact of Fed policy affecting the precious metals space specifically?
Okay, so 2020, March till August, you saw a reflation trade just like in 2009. Gold went up 36%. I think silver doubled in a matter of a few months. And interest rates bottomed at 0.5% for the 10-year. That was like insane. And then the bonds market obviously started to price everything in before everyone else because you're just the smartest investors over time. 2021 was the year of denial. So basically, the Fed says this is transitory. The market buys it until it doesn't buy it anymore. And then 2022 and that's why precious metals did not run in 2021 because nobody thought that this is a permanent situation. 2022 it was the flip of that. In other words, the Fed says, "Oh my God, we are way behind the curve. We are going to rain down on this," and so the market starts to price in deflation and starts to price in that the Fed will win. This is going to be a win for the Fed, and so precious metals didn't do well. But now we're at a point where we had peak hawkishness and also a realization that no, we're not going into any deflationary environment at all. So to me, it looks like precious metals have already carved the bottom. And in the next few months, as we see what the Fed does, in other words, is it going to be a terminal rate of 4.75? Is it going to be 5? Is it going to be 5? That's going to dictate how high precious metals will go. But I think that silver specifically is already in a bull market, and gold is forming that bull market. And tactically, we are in a bull market for precious metals.
So there's a lot of talk of the end of US dollar hegemony and that the world is slowly turning away from the US dollar. We have the BRICS nations discussing creating an alternative form of currency that's either backed by a basket of commodities, potentially could be backed by gold. And we're seeing countries want to move away from the US dollar when it comes to trading. So do you think this BRICS nations current currency will actually come to pass? And do you think it could compete with the US dollar as the world's reserve currency?
I actually don't think that there's any reason to be concerned about this in the next few years, perhaps even a decade plus. Currencies are built on faith, basically, and so you only get one chance at creating a currency that's trusted. And China's just not there. Russia's just they're not there. The dollar is not perfect. It's almost like all countries have a dysfunctional marriage with the dollar, but they rather have a dysfunctional marriage than an ugly divorce. And I think that at this point, that's what the world has now. Could there be tests and pilots and all kinds of shenanigans? Sure, but at the end of the day, if you ask the average institution, the average central banker, and just the big money players in the world, would they hold their money in one currency? They will unanimously answer the dollar. So we're just not there yet. I do think that there is way more of a reason in this decade to hedge your foreign reserves and to not just be solely dependent on the dollar for many reasons, primarily deglobalization, but a commodities bull market, which helps the Australian, the Canadians, the commodity currencies. But in general, no, I don't see any cause for alarm. Usually, you have currency systems form at very acute crisis. 1971, you had Charles de Gaulle basically asking for an audit of the Fed, or driving Europe away from the dollar. Like, they were about to have their own currency, their own euro backed by the dollar, and I'm sorry, by gold. And Nixon, took action to make sure that doesn't happen on his watch, and started the fiat monetary system. Other currency events during the last 30-40 years, they've all had a lot to do with crises. So I think that's where the dollar might come into question, when there is a real crisis in the dollar. And to me, a crisis in the dollar will only happen as millennials hit the peak earning years at 2029 and beyond, and perhaps when China has a bigger military budget than the United States in around 2035, 2037.
So it sounds like the BRICS nations currency in your mind is kind of more all talk at the moment, and actually implementing, issuing, getting people and institutions to adopt it would be an entirely different matter. I tend to agree with you there that it's going to take a lot longer than people think if it does come to pass. What about another form of gold-backed currency? You hear especially gold and silver bugs talking about a return to sound money. We need to get back to a currency that's backed by gold, or backed by both gold and silver. Do you see something like that coming to pass at any time in the near future, or is that another thing that could be as far as a decade away?
I don't see that happening at all. Neither from the political sector, the business sector, the central banks. There's no one is saying, hey, we failed here for 50 years under this fiat monetary system, therefore we need to go back to some sort of a gold system. So it's not part of the culture. It's not part of the millennial culture, which is the future. I think that you will see more hedging in this decade, because the 60-40 portfolio just had its worst year ever. So bonds and stocks can now, in people's minds, and we all have very strong muscle memory. Now, 60-40 portfolio is not bulletproof. Like, bonds and stocks can fall together for an entire year. So now there's a reason to say, okay, well, how about some 2-3% here and have some gold in my portfolio, because there's inflation, because there's deglobalization, because there's ESG compliances, and that means that pulling gold out of the ground will be more expensive. There's all sorts of reasons. There's price caps. There's countries that are sanctioning each other. We need to hedge with the only hard currency that has nothing to do with any country, and that's gold. Now, the average person might hedge with silver just because he can't afford gold that much, but the idea basically is that this remains mostly a retail story. Silver does, and gold starts to become an institutional story. But don't expect everyone to say, oh, I need to turn all of my savings, or 30% of my savings, or whatever, to gold. That's just not plausible. Most institutions will just do short-term bonds or any of those instruments, but they will have a component of gold. And just so we're all on the same page, when gold rallied in 2009 to 2011, the only thing that happened is that gold went from 0.5% of global assets to 0.85. It didn't even go to 1%, and that thing happened. So because gold, all the gold is above ground. It's just a bidding war on the gold. And that's what's really important here. It's a buyer's market. The buyers dictate how much they're willing to pay for this metal.
So what are your thoughts on central banks accumulating as much gold as they have been? I believe we're now at gold reserves at central banks that haven't been seen since the 1970s. Do you have any theories as to why the central banks are purchasing so much gold? And do you think this trend will continue? And obviously this seems bullish for gold in the long term. Would you agree with that statement as well?
Yeah, basically, with everyone focusing on a BRIC nation, competing currency, etc., the way that countries right now are distancing themselves from the dollar and de-dollarizing is just buying more gold. And so I see that the central banks will continue to do that. It's a very smart move for thousands of years. A lot, royalty, countries, institutions. It's a no-brainer to have a little bit more gold on your reserves, especially after April 1st, 2019, when the Bank of International Settlements changed it from a tier 3 to a tier 1 asset. So the day that happened, gold was at 1,292 an ounce, which basically means that the central banks themselves value gold for twice as much as on that day, which is 2,584 an ounce. So until we hit that price, central banks buying more gold is something that we will continue to see. And the reason is the dollar is a problem, not just because of the fear of sanctions and deglobalization. It's also a problem because you're giving a lot away. When you have a world of high inflation, if a dollar is on your reserves and the dollar is appreciating, like in 2022 when it's at an all-time high versus other currencies, it can cripple your imports and exports. You're really giving your jurisdiction, your local economy, you're giving it access to the international speculators, and you can only hedge that with certain things like gold. Gold is very uncorrelated or inversely correlated with the dollar. So I do see that continuing.
So let's take a look at the broader commodities complex, maybe step outside of the precious metals for a moment. It sounds like you believe we're in a bull run for the precious metals, a bull cycle, and as well as commodities. So I'm just wondering which commodities you see benefiting the most in the years ahead as we enter what some people are calling a commodity super cycle.
Most bull markets start with copper leading. Copper is obviously one of the most used commodities in the world, and they found a lot of new uses for it. We have just finished a 12-year cycle of underinvestment in commodities. There are depleting mines everywhere. There's more regulations on how you pull out of the ground, and reclamation costs, which is how you put the mine back, how you put the ground back together so that it's usable after the mine is depleted. That makes mining very difficult. Technologies to discover metals have not improved materially. It's improved materially in oil and in natural gas, but not in metals. It's still very much a guessing game, and that makes it very expensive to drill and to explore. I think that in general, the way that investors hedge for inflation is through infrastructure, because infrastructure is a deal I can strike with a government or with municipalities for a 10-year contract with fixed costs, and I know everything, and I can hedge on the futures market. That's why I think the last decade of disinflation, everything was about growth. Like, how do I put my money where I can make 3, 4, 5, 6, 10 times, because there's no yield anywhere. This decade is about how do I make sure that inflation doesn't eat my lunch. And with higher interest rates, the way you do that is in infrastructure. That's where you get a guaranteed rate of return, and that or a more reliable rate of return. And anything that's unreliable, you can hedge, and I think there will be a lot of hedging strategies that will form. So more need for infrastructure across the world, especially in the developing world, China, etc., India, Malaysia, Nigeria, Africa. I mean, I can name about 3-4 billion people that need more infrastructure, and the United States. I mean, my God, talk about like you need an upgrade like it's nobody's business. The roads, things that are simple, and I'm not even talking about the fact that you have a 2.5 million people shortage in jobs, which means that a lot more automation, robotics are going to come in. Divesting out of China means way more production in Canada and in Mexico. That means new logistic routes. I mean, the world is resetting. It's resetting big time because China is not playing the globalization game anymore. Their economy is big enough, their domestic economy is strong enough, so they can focus on a domestic economy just like a lot of other countries do. They have a middle class that's now more robust. They don't need to keep manufacturing for the rest of the world, and they're closing. They're closing down. Their mentality is not to be playing ball with the West. So that this whole thing means way more important is not to get the cheapest commodities like we've had in the last 30 years, but the most reliable commodities. In other words, if I need lithium, if I'm the United States and you're China and we both need lithium from Latin America, we will be needing to pay more to get our share because we're going to be competing on this, and there's not enough. So I think that's why commodities in general will have a bull market in the next few years that's going to be pretty strong. And if you're asking me like which ones do I think will be important, I think that as I said, copper will be a leader. Silver could do very well. I think silver can hit the 50s and the 60s during this cycle. Nothing is holding it back from doing that. It's honestly one of the only 32 major commodities that is not trading above its 1980 high, way below it, right? You're like 20% below that, and then there are all these commodities that will have spurts. Like you will have shortages here, you will have something technological here, and it just happens. You don't know which ones it will be, but just you need to keep your your pulse on it.
Right. Now you mentioned more regulation on mines, a lot of ESG regulation, ESG red tape. We've got the whole new green economy agenda that's getting pushed in a lot of countries, which is kind of hypocritical because a lot of the minerals, metals needed to create renewable energy require a great deal of mining. And a lot of the same politicians who are asking for renewable energy hate mining and they don't want it in their country. So we've reached kind of a hypocritical dichotomy. I don't know what you want to call it. We've also seen Vanguard being the first major asset manager to throw in the towel, on this whole thing and back out. Are they the first in a long line of dominoes to fall? Is the pendulum going to swing the other way eventually?
I do believe so. I think it's already started. I think ESG wokeness, in other words, unrealistic expectations of how the world is going to transpire, was part of this zero interest rate culture. Just like Twitter was, just like many other things, were part of this culture that is over. Okay, so in 2050, we will consume the same amount of oil as we did in 2013. That's an ExxonMobil study. Believe me, they want to study that topic. Between the U.S. is 4% of the world's population, and that's not where the growth is at. Africa is where the future is. India, Indonesia, China. I mean, these are countries that are going to Latin America to a degree. These are countries that could care less about your ESG compliance of the West. They need to create the infrastructure for their citizens. And yes, I do think people care about ESG. I do think that's gonna stay. People do care about saving the planet, quote unquote. And I do see that will continue being an important part of the energy sector, but it's not something that is gonna dominate. You will see oil 50 and 100 years from now getting pulled out of the ground and used, natural gas, etc. Actually, the one interesting energy source that is now taking rise is nuclear energy. And I do think that will play a bigger role. Most people have largely forgotten about Fukushima. Even the Japanese are putting back reactors into production. It's very safe if you do it right. It's reliable. It's cheap. It's abundant. And to tell you the truth, the United States is the largest consumer of uranium in the world for electricity and heating. 20% of U.S. households get their electricity and heating from nuclear, and the United States has 0 domestic mines. They import about half from Russia. So if you're talking about the stranglehold that Putin had over Europe, I mean, the same can be said about what's going on here. So I think that you're going to see a lot. If I had a kid that's just fresh out of college, I would tell him, look for a job in the nuclear industry in America. It's a barren landscape. There's only like 450 people employed in the entire United States. 450 people. So I do think that that's an energy source that's going to be making a huge comeback. And you know, in general, I don't think that that ESG compliance is going to make solar and wind, etc., more more abundant, because you've had large government subsidies to get us where we are with those. And in 2024, I think you will start seeing that the elections are all about fiscal responsibility, and a lot of these programs will have to be dialed back.
Yeah, you have pretty much the exact same view on the energy space as I do. I mean, I also see nuclear as a big part of the future. I see us needing oil basically for as long out as we can imagine. I mean, oil and gas are the lifeblood that allowed us to build the civilization we have. Unless we want to return to the dark ages, you can't just shut it off. So I'd like to finish here on the meltdown of FTX, general collapse of the crypto market, and all of these exchanges. I mean, they were offering these really attractive yields. Just stick your crypto here, we'll give you 7, 8, 9% yield for nothing. I mean, that's a tale as old as time. It's too good to be true. It probably is. So, do you think we're going to start to see a bit of a paradigm shift, and people are going to start to realize that they need to look to hard assets and commodities, and maybe some of that capital will start to flow into precious metals and the mining space moving forward?
It's a good question. I think that in general, currencies are going to get digitized, whether it be central banks, commercial banks, etc. The future is to complement paper money with digital money more and more, and because it's faster, cheaper, it's more secure, it's cross border, and it's obviously more inclusive. You have so many people that don't have banks and they do have phones. So I think the future is there for digital currencies. I don't think that the future is there for crypto projects, or whatever you want to call those. Trading those is just a symptom of the zero interest rates economy. That's it. And I think that what happened with FTX and the like, with I think it's called yield farming. It reminds me of the subprime mortgage bubble. It's securitization of assets that are not secure. So and obviously, there's going to be problems with that kind of business model that is inherently super risky. And just like in 2008, they were either too arrogant or unaware. I don't know, a mix of everything. In general, I think that millennials are not going to sit there and say, okay, this means I need to start buying gold and silver, and we don't need them. We don't need the millennials for gold and silver. In general, I think that gold is mainly an institutional story, and that silver is a niche story within the retail space, and only 20% of silver buying comes from retail. 50% comes from an industry, and the other 30 from jewelry and otherwise. You don't need the retail to dictate the price. What dictates the price of silver, for the most part, is industry. And when you put just a little bit of silver in thousands of components, I mean, it doesn't change their price. If silver was 50, it wouldn't raise the price of an iPhone or of a solar panel. It doesn't mean anything. You're using micro milligrams and little grams in thousands of these products. I think that's what's important here, is that FTX has brought this to the mainstream, and it's now a debate. And so I think that central banks will use this, and governments will use this as a way to bring more regulation to the space. I think that in general, what you're going to see the Bitcoin diehards that want to keep, I want control over my own assets, my own money. I want to have the keys. They will remain there. Most people want a mommy and a daddy. if there's credit card fraud or anything, I want to call hello banker, I want this. So most people want that, and I think that central banks also know how tricky it is to create a central bank, a digital currency. They will not want to screw this up. So I think it will take them years and years of pilots and tests. And at the end of the day, I think that what they will come up with is a wholesale model just between the central banks themselves of digital currency. The retail digital currency, I think, will be JP Morgan, Bank of America. Your local bank will issue perhaps digital to complement the paper money. But if you're one of those people that say they want to take away all of they want to know everything, that this is all about giving them all the control. It's not going there. This is not where this is going. And they know it. We know it. The whole world knows it. So I don't think that's a legitimate fear. There's these tests and pilots, like in China, they just did a pilot, Jesse, for 128 million people. They gave them a digital coin, and so they're studying it. They're so far away from actually rolling it out that this is something we'll talk about when in 2035, 2040. This is not coming soon. It will come in like tests and pilots, but it's not going to get ushered in. As I said, even the central banks don't want to create their own retail currencies at all. And I've listened to hours and hours of the BIS talk about it, the Bank of International Settlements, central bankers talking about it, the Davos World Economic, they don't want it. Believe me, it's one problem they don't want. They like the system they have right now. So I think that's important to keep in mind. And at the end of the day, like I said, it's not a valid fear. It's a paranoia to think that they will take you out of the system, in the Matrix or something.
Well, thank you so much for joining us today, Lior. For those who want to hear more from you, where's the best place for them to go online?
Go to wealthresearchgroup.com. We publish a free financial newsletter. It's going on for now the 7th year, Sunday, Tuesday, and Thursday. It's basically me reading and learning about economics, putting everything in my head, then talking to hedge fund managers, real estate fund managers, and putting all of that together in 3 articles a week. I also publish my own portfolio and interesting opportunities that I come up, that come my way, and I want to share. And if you want to check out some of the PDF reports that we put together, especially for your viewers, either go to wealthresearchgroup.com. On the website, click the top menu button that says Special Reports, and you can see a whole wealth library of those download reports. And the one that I think is most important, because we haven't touched on it, so I bring it up, is Taiwan, which I think could be ground zero for a physical, a military altercation, and even more so, a little trading corridor called the Malacca Straits. So if you don't know what those are, please go to wealthresearchgroup.com/Taiwan. It's 20% about Taiwan, 80% about Malacca, and I think people should know that, because every time they hear that word, they should listen to whatever the updates are in the media.
Great. Well, I'll put a link in the description below so people can find that. Thanks so much for joining us, and would love to have you on in the future to continue the conversation.
Thank you, sir.
Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.